We've got two different things we're going to bring to you guys, two different illustrations of different policies for life insurance. One's going to be an index universal life insurance policy. The other is going to be a whole life insurance policy. And this is going to be really powerful because these are actually my policies. They are both mine. I use them, or I should say I use one of them. The other one's kind of in the background, but we're going to compare them so you guys can see really what's going on behind the scenes with both of these policies.
I think that is what's going to make this so powerful. Is this is a real story, folks. This isn't a hypothetical illustration. This is his story and his policies. And the way that he came about this information is pretty unique. But the way and also the execution of how it was done is the most important thing.
Absolutely. So this was about a year ago. I heard about this guy on a podcast, and I was intrigued. I went down the rabbit hole and just learned as much as I could about becoming my own banker and controlling my money. So I was ready to start a policy. I was gung-ho. We had a couple $100,000 in capital that we could dump into a whole life insurance policy. And I had people in my ear saying, that's not how it works. You can't do that. You're going to put the money in. It's going to be trapped for 8, 9, 10 years. So what did I think? I got spooked. I started thinking, what if all these people are right? What if this guy Chris is a slime ball and is going to steal all my money, right?
Sounds too good to be true.
That's what I thought. So what did I do? I tested the waters. I started a policy for $6,000. And $6,000 for me, it was not going to make or break me. If I could not touch that $6,000, I would be okay. So I tested it. I put in the $6,000. And I wanted to see if I could actually access that money like I was reading about, like I was hearing about. I was able to get $5,200 of that $6,000 back out. Get this, the next day. It took 24 hours. That doesn't always happen, but with this policy, it just happened to be able to get it out 24 hours later. So I was able to use $5,200 of the money somewhere else to make me more money. I lent it to somebody, and they paid me 15% interest. The whole time, the $6,000 I put in continues to grow uninterrupted from the compound interest. From that point on, I was sold. What did I do next?
Well, he did a lot next, but let's take a step back, because before this even happened, before we designed and engineered this specialty whole life that we're talking about here, Devin also set up an indexed universal life, commonly known as an IUL. So IULs are very popular in the marketplace, in the investment advisory world, the financial advisor world. They sell a lot of IULs. And there's a lot of people out there that are out there talking about IULs as the silver bullet, you know, like the one and only, the greatest financial tool ever built. That's how I'm hearing and how Devin was hearing about IULs. And I'm not saying that's true or not true, but when you actually hear something like that, you really have to do your due diligence. I spent 16 years as a financial advisor. I've seen products come, I've seen products go. The whole time, whole life has been around for hundreds of years. It's never done anything other than what it was absolutely designed to do. But IULs are very similar to products I used to do as an advisor called VULs, Variable Universal Life. But they have a floor, a guarantee, because VULs, including the one I own, they have problems. In 2008, when the Great Recession hit, my VUL plan exploded. When the market tanked, my separate account of mutual funds dropped, and all of a sudden, the company sent me a letter that my policy was going to lapse unless I put more money in. Now, how would you love to hear that? You got this vehicle that's supposed to perform forever till the day you die, and you're supposed to be making all this money in this basket of mutual funds, and then all of a sudden, one recession happens, and immediately you get a letter saying your policy is going to lapse or disappear, which means no more legacy for my family, which means all the money I put into it vanished because of one downturn in the market. That didn't feel well. Fast forward to where we're at now. Companies have gotten smart. These insurance companies and financial companies have built IULs, so now there's a floor underneath the amount of cash that you can lose. You can't lose money. You can only make money. That's what they say. How did you come about IULs? How did this whole index universal life come into your financial picture? Like, where was that? And at what time did that kind of play into the whole life story you were hearing about infinite banking And then how did you decide which one was best? Or did you just say, I'm going to try them both and see which one really works?
It's actually exactly what I did. So as I was saying, guys, I started a whole life insurance policy for $6,000, right? Like I said, it wasn't going to make or break me. I put the 6,000 in. I was able to leverage 5,200 of it to go make money elsewhere at the same time. So I'm making money in two places, technically with the same dollars. So I'm thinking, IUL is probably just as good, right? The person that was in my ear was telling me, this is going to be way better. You're going to get 6 to 7% average. And that was before I really understood the difference between an average return and an actual return. There is a difference. So I put 6,000 in the IUL. Did I have access to 5,200 right away? Absolutely not.
Not by the numbers.
I didn't have access, or I don't have access in year 2. So 12,000 goes in. I don't have access to anything yet. Year 3, another 6,000 goes in. I still don't have access to anything. The way I look at this IUL is it's completely different. It should be completely different on how you use it from a whole life policy if it's engineered the way we engineer ours. It should be used for retirement. Think about a retirement plan. You put money in a 401k knowing you're not going to really touch it, because if you do, you're penalized, right? You can't touch it till you're 59 and a half. So if you do an IUL, you should almost treat it like a retirement plan. Put money in there that you don't really have any plans of touching. But a specially designed and engineered whole life insurance policy can literally be used to just take back control of your money now when it's worth the most. Your money's going to be worth less tomorrow, the day after, the year after. I'm 36. By the time I'm 59 and a half, who knows how much the dollar is going to be worth.
The funny thing is, when you put money into something, I know you might have a goal of a long-term thing like retirement. Or maybe you don't need the money, or you don't think you need the money for 20 or 30 years into the future. But wouldn't you want access if an opportunity presented itself? If the next Uber presented you a partnership option and you're like, oh boy, I wish I could, all my money's locked up for 20 or 30 years, there's nothing I can do. That wouldn't be good for your future. That wouldn't be a good scenario.
No.
Oh, but you put the money away for long term, which is what that's designed to do. I just think sometimes people want options, and I think people need to be in control of their cash so that when bad things or good things present themselves, you have access to the money. Whether or not you need it now, control is a very important thing.
I think one of the biggest things, if you compare the two, take an IUL and a specially designed whole life insurance policy with a mutually owned company, if you take the two and put them side by side, what's the biggest difference? In my opinion, it's the guarantees. Whole life insurance policy has so many guarantees. We're talking about guarantees on fees, costs. Those stay level the entire time. So at the beginning, your policy isn't as efficient, but every single day, every single week, every single month, every single year, it gets more efficient. With an IUL, that's not the case because fees, costs, they're not fixed. They renew every year. Every year you get what? Older. Every year you're older, you get more expensive to insure. So the cost goes up. With a whole life, it stays level. And not to mention, basically with an IUL, there's a 0% floor. So the whole sell behind an IUL is you can't lose money, right? So if you hit that 0% floor when there's a downturn in the market like '08, you're not losing money, right? But what happens if you're 60 and the fees are through the roof? How do those fees get paid? Those get paid by your cash value. So yes, you can lose money in an IUL. So that's what I love. The difference right there is just the guarantee. In a guaranteed environment with a whole life insurance policy, it just gets better. It never gets worse.
And again, I want to go back to whole life. It's like a swear word. Does anyone feel like, when we say the word whole life, you're just dragging your nails down a chalkboard? Because most of us, that's how we feel, because that's what we've been taught. Or we just haven't been taught the right things about how whole life works. See, we're not talking about a regular off-the-shelf whole life that you buy from your brother-in-law or the insurance store down the hall. We're talking about a very specially designed, engineered vehicle that just happens to be a whole life contract. So the best way to do it is, you notice Devin's shirt, NASA. So NASA designs rockets. And they design and engineer rockets to do all sorts of different things. One rocket is designed to go to the moon. The next one's designed just to go outside orbit to drop off a few satellites and pick up a pizza and a Coke on the way back home. And then maybe one's designed to go all the way to Mars or beyond. You know, like that Bed Bath & Beyond. We never know what that beyond thing is. But what I'm trying to explain is there's not one rocket that's designed exactly the same for the exact same purpose. Just like whole life. Whole life, as a contract, can be designed and engineered to do all sorts of things, just like those rockets. And we design these to do whatever our clients need. If our client wants to design a plan to have access to that money immediately in the next 30 days, that's what we do. So you got to change your mindset. You got to understand that this is not the whole life that you have been taught about your whole life, or that you have been told is the worst place you can put your money by some of the gurus. This is completely different. And that, I think, is a big stepping stone for people. I think a lot of people stop right there when they hear whole life. Oh, but this IUL is really sexy because it's new. Because IULs have probably been around, I think, about a decade, maybe a little bit longer. So, you know, it's a relatively new product, therefore it's got that shelf sex appeal. But here's what I really want to do, Devin. I want to take your two plans. I want to just get into the numbers. Starting with guarantees. We all like seeing guarantees. That word just has a great sound to it. Guaranteed. Love it. So if we just look at the numbers on the guaranteed, we see the story unfold right before our eyes. And it's not by us telling you that these are better or worse. It's simply math, folks. It's compound interest in math on a guaranteed basis. So take a look at this.
You know what I like to say? Men lie, women lie, numbers don't.
Well said. And let's get into the numbers a little bit. So if we're looking at the numbers here, I mean, if it doesn't matter really where we go, but even let's just look at year two. Year two, we put $6,000 into the specially designed and engineered whole life, and we also put $6,000 into the indexed universal life. So it's apples for apples. And when you look at the numbers, your whole life policy has $4,349 available that year. So you put in $6,000 and you had $4,349 available. So you had a total of $8,317 accessible to you. And over here with the IUL, the Indexed Universal Life, you have $7,768 in value that's growing in the policy, but how much money do you actually have access to?
A big fat goose egg.
That would be zero. And as we go down the line, we don't get, in the IULs, this is guaranteed, folks, we don't get out of that level until year 5. So year 5 is the first year in your IUL that you would have access. So if any of the time in 5 years an opportunity presented itself, you got in hard times and needed access to your money, in the IUL you would have had access to none of the money.
Right. Until the end of the year, I'd have access to about $4,800, and 5 years in, that means I've put in $30,000. I've got access to $4,800.
And in the specially designed and engineered whole life policy, you've put in $30,000, and you have access to $24,157. That's guaranteed. So you put in $30,000, and you can take out $24,000 and change and use that money to make more money on anything. That's what we do. That's why we do this.
I can buy a whole bunch of shoes and resell them. I can buy some rental properties. I can invest in cryptocurrency and go to the moon while my $30,000 is still compounding.
And I think that's the thing, when people look at an IUL or a whole life and they're saying, which one's best for me? I don't know if there is one that's best, as a general rule, but I think the question should be, which one's best for your particular needs and goals financially? So when we look at it, for someone that wants access and control to their money, clearly the whole life has given you access and control to a lot of the money that you're putting in each and every single year. And this is guaranteed. We haven't even got into the good stuff. These are just baseline guarantees. And the IUL did not. But, the story changes very quickly with the IUL. And when we do the returns, we're looking at cash on cash return. In other words, so a lot of people, when they look at returns, there's many different ways to calculate a return. There's cumulative returns. How much money have I put in that case, 5 years, $30,000 in both contracts. And how much do I have? That's a cumulative return over a period of time. You've been taught that that's the only kind of return because most of you put your money somewhere with an advisor or in a 401k, and you can't take that money, so you're only looking at cumulative. But how we do this for banking is cash on cash. Real estate investors understand this because how much money you put in each year, of that money I put in, how much did I make on that deposit? So that is a cash-on-cash return. And in a vehicle like this, either one of them, that's really the return you should be looking at. If I put in $6,000, how much is my return on the $6,000 that particular year? Just wanted to be clear about that.
100%.
So what do these returns look like? Where, this is guaranteed, but we got some big negatives over here on the IUL side.
Yeah, so
Just start at year 5.
if you look at year 5, so the guaranteed cash-on-cash return would be negative 19.6%. So I put in 6,000, I lost 19% of my money, technically.
And the guaranteed cash-on-cash return at year 5 for the specially designed and engineered whole life is still negative, but it's only negative 2.5%. And then that changes very quickly. So if we go down to year 10 here, or actually let's do year 11 because, there's something unique about an IUL is by year 11, the amount you have in the plan is the same as the amount you can take out. They call it the surrender value. So you have your actual value and then you have the surrender value in an IUL. And in your contract that the guy that you dealt with, and I can't use his name, did, in that one, it's 11 years before what you have is what you can use. So if we just look at year 11, your cash value in the whole life policy would be $59,415. And the cash value in the IUL, the indexed universal life, would be $41,282 guaranteed. No returns, that's just the guaranteed value. But look at the cash-on-cash return in that specially designed and engineered whole life in year 11. It's 94.47%. That means you almost doubled your money. This is why people say this sounds too good to be true, but it's not. It's just math. The cash-on-cash return is how much money your money earned that year. And then the IUL, it's a positive number, but what is that number?
So we're at 28.2 cash-on-cash return guaranteed at year 11 in the IUL.
So when we're looking at it, we're just looking at base guaranteed levels. You can see the whole life in a period of 11 years has outperformed the IUL in every scenario here. And it gets a bit scary as we go down. If we go down, if this was for retirement, and let's say that somebody wants to retire in year 20. In the 20th year, their guaranteed cash-on-cash return in the whole life is 173.2%.
On the 20th year in the IUL, it's negative 35.9%. So guaranteed, if there's no growth in the market, which probably would never happen, but if we're just going off guarantees, you just have the floor, I'm losing money at year 20.
And the one cool thing about the whole life, that boring whole life that we're talking about here, is there's not a year guaranteed that he has less money than he did the year before. But in the IUL, if we were only guaranteed, and it's unlikely that you'd always have guaranteed levels in the IUL. So again, we're just comparing apples to apples. In the IUL, the story gets worse and worse, and actually gets
pretty scary.
darn frightening.
Yep.
The numbers get into the negative 100s and beyond. So instead of like the whole life, the numbers getting better every year, in the IUL, they keep getting worse and worse and worse. And the reason for that is every year you're getting older. Every year, the internal cost of insurance within the IUL, your costs go up every year. But you know what? Most people that are watching this are like, yeah, that's great, but let's get into the good stuff. So let's talk about non-guaranteed values, because this is what people really want to hear about, Devin. Everybody's optimistic right now. Everybody really wants to just see the numbers that they're going to earn non-guaranteed. So let's just give that to them.
This is kind of what sold me on an IUL too, guys. A lot of people look at IULs and they think, man, this thing illustrates amazing if I get these returns. But this is assuming there's never a downturn in the market, which we all know that happens. It goes in cycles. There's always downturns in markets. Now, that's the difference, like I said before, an average return and an actual return, right? There is a big difference between an actual and an average. This is looking at average returns through an IUL, okay? So it's going to illustrate really well, but that again is assuming you never have a downturn, which changes the actual returns.
Yeah. And a lot of people, when we talk about that, they will say, well, yeah, but one year I'm going to make 10%, the next year I might only make 3%. Yes, it's going to vary. But on that 1 year that you lost, or that you were at 0%, or in the guaranteed case, negative numbers, if you were to have taken money out of that IUL, you would very much affect the future performance of that vehicle. In the whole life, it doesn't make a difference either way. So now what we're going to look at is, instead of looking at guaranteed numbers, we're going to look at hypothetical numbers. And for the specially designed and engineered whole life, we're looking at, for Devin's contract, his contract has a rock bottom 4% guarantee, which those contracts, you will not be able to get a 4% guaranteed whole life after 2022. I just want to be transparent. That rate's going to drop to somewhere in the 3% range. But in his policy, he also gets a dividend. Now, dividends are not guaranteed in whole lives. However, the company he's with has paid dividends for it's over 160 years. Is it 168 years?
Mass Mutual, yep.
Yeah, 168 years they have paid dividends every single year. Now, they've changed in value. The amounts have fluctuated to as high as double digits, and where they're at right now, which is 2%. His whole life that we're going to look at shows a 2% dividend. Not guaranteed, only the 4% is. The IUL that we're looking at has a guarantee of, correct me if I'm wrong, is it 0?
0%, right.
So you can't lose any money, but that's your guarantee is 0. Then his hypothetical return on the index, is it 6 or 7, somewhere in there?
6 to 7, I believe.
6 to 7%. Okay, it doesn't matter. I mean, we're not getting exact. His illustration was by an exact number, but it's somewhere in that range, which is more than what the whole life would pay with dividends. So the IUL we're illustrating on the non-guaranteed side is showing a higher return than what the whole life does. But let's just get into the math and the numbers again. In the second year of the whole life, you put in $6,000 and it grew by $4,394. Let's take a look at year 5, because something interesting happens here. You put in $6,000 and the whole life policy grows by $6,032. This is where your policy breaks even. We call this the efficiency zone. This is where every single dollar from this point forward will have more money coming out of it than what you put in. So if you deposit $1, you get more back than $1. This is one of the most important parts of how uninterrupted compound interest works. In the IUL in year 5, you put in $6,000, but the value of the policy is only $22,707. And you can only use $9,057 of that value.
It takes a while for the IUL to actually even get to where the whole life is at, and that's on non-guaranteed sides. So again, assuming there's no downturns in the market. With a whole life, it's based on dividends, which are based on profitability of the insurance company. And profitability basically rolls with interest rates. We're in a low rate interest rate environment. That's why the dividends are low. If rates go up, what's going to happen to dividends? They're going to go up. So these numbers would probably underperform what a whole life would actually do, right?
It's possible, but again, now we're in that hypothetical world. So, if we just go off of where we're at, there's a lot of merit to that. We're at the lowest interest rate market we've been in probably since close to the Great Depression, maybe even worse. And that reflects the dividends. So the dividends are only 2%, which is a 31-year low now for the company that Devin's policy was built on. The IUL, again, is completely hypothetical based on market returns on a basket of indexes that the insurance company allows Devin to participate in. And those investments can do really well, and they can lose money. But if they lose, Devin doesn't lose anything in the IUL, which is a great thing. Now, when you did your IUL, what was the main problem you were trying to solve with this IUL?
With this one, I really wanted to set up some sort of retirement.
Okay.
I didn't look at this as any way to have access to my money. I just thought, you know what, let me compare the two and see how they perform long term, because the whole life can also be used as a retirement vehicle. I don't necessarily use it for that. Mainly I use it to just move money and be able to invest in numerous things at the same time, but it can also be used as a retirement vehicle. The IUL, it's the only way I look at it. It should be used for retirement because you don't have access to your money. It really can't be used for anything else until you're 5, 6, or 7,
So by hearing that, you could say, well, the IUL should be better for Devin because he's got a long-term time horizon for this. Now, remember, all of these plans, the IULs and the whole lives, are specially designed and engineered around a specific need and goal. So again, what we're really trying to do is just buy the numbers and buy the math off the illustrations from his policies, which one actually solves his problem and which one is a better fit. So if we really were to look at that, I mean, we've already determined that in the short run, clearly the IUL would not fit any short-term needs and goals.
Right.
So what you did with the whole life is you took a loan out immediately and you lent that money out and you made 15%. So you didn't just make what the whole life makes, you made money twice. And I think you're the guy that came up with making money 5 times by doing one thing.
Yep.
So if you want to see that video, make sure you check out Devin's other YouTube video, but we're going to really just stay focused to this one because this one's goal was retirement, but he decided that to get to retirement, one of the best ways to make the most amount of money is have your money working for you every single second of every single month and year. And that's what he did. Put money into the whole life, took it out, and made that money go work. He couldn't have done that in the IUL because he's just got to leave it there until some future date when that money's available. So if we take the non-guaranteed values and we fast forward down to, let's just go to year 10. Okay? And you can see the numbers on the screen. You can see where they're at. You can compare the 2 columns because some of you really like getting into the numbers. And these are right off the illustrations. We're happy to provide and show you the illustrations on both of these contracts. Devin was nice enough to provide us the transparency to show that because there's always going to be some haters out there that say, oh, those aren't the real numbers. Why, yes, they are, and we will provide those if you want. But this is just a spreadsheet breaking it down. So by the 10th year, you're putting in $6,000 into each contract. You put $6,000 into your whole life, and then you could take out $7,466, which represents a cash-on-cash return of 24.43%. That's pretty impressive. That's a number that myself and a lot of people would love to make on their money. But the IUL is also pretty impressive. What was that number?
34.8.
But let's focus on how much money you have in each policy because some people want to know how much they will have in total. So the whole life had $58,972 and the IUL only had $50,000. But of that $50,000 that year, he could only take out $46,812. So you see, we're starting to turn the corner in the IUL. We're starting to make more in the IUL, but we're still working off of a lower base because you gave up a lot in the beginning. We have some catch up to do here. So as this thing keeps going and we start really looking at the numbers, we very quickly start to see from a return standpoint that the whole life is spanking the pants out of the IUL. Okay? So a lot of people say, well, over time, shouldn't it be making more? Well, it should, but you see the whole life has a level fixed cost of insurance. So there are costs to both of these contracts. We have to always talk about the cost because everybody wants to say, well, what does it cost to get one of these? Well, there's a cost for the insurance. But the whole life, his cost has been the same for all 10 years. The IUL, it's gone up every single year. And it will continue to go up every single year Devin's alive. So when the internal cost, the cost of insurance, goes up, it starts eating away at his returns. For example, in year 11, the Index Universal Life has an 83% cash on cash, and the whole life had 138% cash on cash return. If we went down to year 15, the return on the whole life is 187% cash on cash, and the return on the IUL is 51.5% cash on cash. And so when would you, if this was for that retirement goal, let's just say that you never wanted to take any of the money and you just used it for retirement. What year were you going to retire? Because with these vehicles, they're non-qualified. You don't have to wait till 59 and a half like you do a 401k or an IRA. You can start taking money out of these things anytime you want for retirement. So what was that year for you?
For me, it was year 65. So when I'm 65 years old, that would be year 20.
Year 20. So let's just come down here to year 20 and let's look at, you were putting 6. And the other thing too that's really unfair in the way that we're showing this, folks, and you can see it right from the numbers. In the whole life, Devin wasn't able to continue putting $6,000 per year into that plan. After year 10, he could only put in $1,500. He's still putting $6,000 into the IUL though. I just wanted to show you that since it's going to look like the IUL has more money in it if you just look at the cash value, but that's not really the case. It's just he's putting more money in to the policy with premiums. That's why we're only going to focus on the cash on cash return, because we want to just get down to the math. And we want to focus on the performance of each policy. So if we go to year 20, you're only putting in $1,500 into the whole life, and you're putting $6,000 into the IUL. And your whole life has a cash on cash return that year of 273%. Whoa, don't write home about that one. You only made 273% on your money that year. Whereas the IUL at the hypothetical market-based return is
110%.
So it doesn't matter where we go with the numbers, folks. You can see no matter where we go, if we go to year 30, the whole life outperforms. If we go down to year 40, yep, the whole life still outperforms, which I actually thought for sure there was going to be a point where the IUL took over. It looks like it might be at year 46. So Devin, that's what? When you're 80 years old, I believe? So when you're 80 years old, the IUL will start outperforming the whole life policy, but only, and only, if the market returns remain stable at about 6 to 7% that entire time, which is what the IUL is showing as a hypothetical return. So the real question would be for Devin, since this is his policy, which one of these would have solved your problem the best?
100% the whole life. With what I do, I need control of my money. I need to be able to use the money. And I get this all the time from people. I talk about whole life, and they'll say, well, why don't you do an IUL? IULs are going to give you a bigger cap. You've got a cap of 12%, 14%. You can earn that all that upside and have none of the downside because you've got the floor. But what people aren't understanding is whole life gives me access to the money now. So I get the 4% guarantee plus dividends, but I can also use the money. And now I'm uncapped. I can make as much as I want outside of the policy while it's still making money in the policy at the same time.
And that's one of the main reasons the wealthy use whole life insurance as a banking instrument or as a private banking system is because of one thing and one thing, well, really two things, the taxable advantages of this, but mostly because of uninterrupted compound interest, the ability to use your money and still make money on all of it even though you took it out. And, in those examples where he put $6,000 in and took $8,000 out, he was making money on all of it, not the net of what was left in his account. That's the magic and the secret of how this works. Now, the IUL will do the same thing, but again, you've got a lot of factors. You've got a rising cost of insurance. You've got market performance that you have to deal with because the markets are very volatile in most cases, and you've all seen that. They're up one day, they're down the next, they're up the next day. Dividends, they lock them in for 1 year at a time. And dividends are a lot more consistent than the markets by a long shot. So depending on your risk tolerances, your goals, your needs, you would want to factor all these things into it when you're deciding which vehicle, whether it's a specially designed and engineered whole life or a specially designed and engineered indexed universal life, you'd have to really factor all these in. Because if you just listen to the people selling you that IUL, you might not get the whole story. Because I bet you any money they're not showing you a side-by-side comparison. This took a lot of time for us to do this.
It did.
A lot of math was put into this, a lot of time. We've been working on this. But folks, we did one additional thing. Because we really needed to make sure we were 100% certain about everything we were bringing to you today. So Devin has a friend, Sammy. Sammy is a wealth of knowledge. Can you talk a little bit about Sammy?
Sammy Franco. So I actually met Sammy on TikTok. I put out videos on TikTok. I grew a following talking about the infinite banking concept, using whole life as an instrument to grow and multiply money while it's secure in a life insurance contract. And Sammy, I saw him commenting all the time, always positive stuff, just reaffirming what I was saying. And I saw that common thread that this guy just really is a fan of my content. And I started looking at his content, and he was talking about the same kind of thing, using whole life. He also uses IULs. So he does both of them. And I actually helped him with this content because it was great content, but the way he was putting it out on TikTok just wasn't getting the algorithm working. So I gave him a few tips, and his channel kind of blew up. So me and him are good friends now, and I'll tell you what, if it's me, I'm gonna do whole life all day long over an IUL. But I'm not you. You might think an IUL is better for you. It might be better for your goals. If it is, please reach out to us and let me get you in contact with Sammy because he will take great care of you.
Yeah, so here at the Money Multiplier and Money School, we don't do IULs. We do one thing and one thing only, and that is privatized banking policies, which are specially designed and engineered whole life plans, and we practice the infinite banking concept, which is just using our money the same way the banks use money. So when you're doing this, again, by the math, you can make a very accurate decision on which one of these two vehicles would work for your needs. We didn't want to do this video bashing one or the other or talking down. Both of them are good vehicles if used for the right needs and goals. But for Devin's goals, you can see the IUL definitely would have let you down.
Yeah, I mean, the IUL is good. It really is. But we like great.
I love that. Why go for good when you can have great? So if you like this video, I urge you, check out my other videos by subscribing to this YouTube channel. Hey, also, hit that little alerts button right up there. It's somewhere up there. Actually, smash the alerts button so that you are notified every time we put out a new video. And don't forget to tell other people about this because there's a lot of people that need help when it comes to their money and how the truth really can change their financial future.